A man earning just $14,000 a year was given a $720,000 mortgage. He couldn't afford the house, he couldn't read the paperwork, and he didn't even speak English. But here's the terrifying part: the bank wasn't making one stupid mistake. That $720,000 loan could be turned into an investment, sold to another bank, bundled with thousands of other mortgages, and moved across the world. And eventually, the financial system discovered something terrifying. A single signature from a man who couldn't afford a house was connected to a bank bailout thousands of miles away. So, how did one impossible mortgage become part of a crisis that nearly brought the global economy to its knees? That's where the real story begins. One thing worth being honest about before we go further: this isn't a history video. The 2008 crisis has an official ending. Congress held hearings, regulators wrote new rules, banks got bigger capital requirements, and everyone agreed on the record that this would never happen again. So, the interesting question isn't how the last one happened. We basically know that part now. The interesting question is whether the actual shape of the problem got removed or just moved somewhere quieter, and you are not going to love where that lands. Let's start with something aggressively boring: a mortgage. For most of the 20th century, mortgages worked like this. You go to your local bank, the bank checks if you have a stable job, a decent income, and enough saved for a down payment. If you qualify, the bank lends you the money and then holds on to that loan for the next 30 years, collecting your monthly payment. This made banks extremely careful. If you didn't pay, the bank lost money directly out of its own pocket. So banks had every reason in the world to only lend to people who could actually pay them back. Slow, careful, boring, and for decades it worked. If you wanted a mortgage in 1975, you needed a real down payment, a stable job history, and a loan officer who actually looked you in the eye. The whole system ran on one simple principle: the person deciding whether to lend you money was the same person who'd eat the loss if you couldn't pay it back. That alignment is the entire reason the system stayed boring for so long. Boring isn't the absence of a system working. Boring is what a system working actually looks like. Here's a trick that changed everything: securitization. Instead of holding on to a mortgage for 30 years, a bank could now bundle thousands of mortgages together and sell them to investors as a single package, a mortgage backed security. The bank got its cash back immediately. Investors got a slice of thousands of homeowners' monthly payments. Notice how reasonable it sounds: spreading risk across thousands of loans instead of concentrating it in one bank. That's not a scam, that's actual sound financial theory. But it severed something critical: the connection between the person making the loan and the person who'd suffer if it went bad. The bank that approved your mortgage no longer had to live with the consequences of approving a bad one. It had already sold you off. That's it. That's the crack in the foundation. Everything after this is what got built on top of it. Think about what that actually means for a loan officer's incentives. Their income used to depend on borrowers paying back their loans over 30 years. Now it depended on volume, on how many loans they could originate and sell this quarter. A loan that goes bad in year 3 isn't the originator's problem anymore. It's whoever bought the securities problem. The person closest to the risk had the least reason to care about it. Here's where it gets worse. Once you bundle thousands of mortgages together, you can slice that bundle into different layers called tranches based on risk. The top tranche gets paid first. If some homeowners default, the top tranche is protected. Because the losses hit the bottom layers first, Wall Street took this top slice, and because it looked mathematically almost bulletproof, AAA was the highest rating available in the system, the same top tier label used for highly creditworthy debt. Notice how reasonable it sounds. You're not rating a random pile of risky loans, you're rating the safest slice of a diversified pool. On paper, elegant. The hidden flaw: the entire model assumed mortgage defaults across different cities and states were unrelated to each other, that a housing slump in Ohio had nothing to do with a housing slump in Nevada. Historically, that had roughly held true. Regional economies moved somewhat independently. The model severely underestimated what would happen if housing prices fell across many regions at the same time, because it had never happened at that scale before. That assumption was about to become the whole crisis. Who was supposed to catch this? The ratings agencies: Moody's, Standard and Poor's, Fitch. Here's the uncomfortable math: these agencies weren't paid by investors who relied on their ratings. The bank being graded was also the bank writing the check. Moody's revenue from structured finance roughly tripled between 2002 and 2006. Nobody had to be corrupt for this to break. Nobody needed to take a bribe in a parking garage. Everybody just had to be reasonable, one meeting at a time, and reasonable when your paycheck depends on giving good grades quietly bends the curve. By 2006, subprime mortgages loans to borrowers with weak credit, low income, or no documentation at all made up roughly 20% of all new US mortgages, up from around 8% just a few years earlier. Lenders didn't slow down and ask whether that was sustainable. Every new loan, no matter how shaky, could be bundled, sliced, rated, and sold within weeks. The faster the loans moved off the books, the faster new ones needed to replace them. Every layer of this, the tranching, the triple A ratings, the whole architecture of safety, rested on one unstated assumption: house prices don't fall everywhere at once. Say it plainly, because the entire global financial system was quietly betting on that one sentence being true. Regional downturns, sure. A national simultaneous collapse across nearly every state at the same time, the models barely accounted for it as a possibility. Here's the trick that made it enormous: Wall Street didn't stop at bundling mortgages once. It took the riskier, lower rated slices nobody wanted, bundled those together again into something new: a CDO, a collateralized debt obligation, and got a fresh round of AAA ratings on some of those too. Then it went further. Investors who didn't even own any of these mortgage securities could buy insurance like contracts, betting on whether they'd default, credit default swaps, except this insurance had no requirement that you actually owned what you were insuring. That isn't insurance, it's a bet. Anyone, anywhere could wager on the collapse of a bundle of mortgages they had nothing to do with. By 2008, the credit default swap market carried a notional value of roughly $62 trillion. Dollars. World GDP that year was about $58 trillion. Dollars. The notional value of the CDS market had reached roughly $62 trillion, dollars, a number larger than global GDP. But notional value wasn't the amount that could actually be lost. 2006 US home prices peak, then begin to slide. Early 2007, subprime lenders start collapsing. New Century Financial files for bankruptcy. Summer 2007, two Bear Stearns hedge funds stuffed with mortgage securities become worthless almost overnight. 2008 March, Bear Stearns itself is sold for pennies on the dollar in an emergency deal brokered over a single weekend. The 7th of September 2008, Fannie Mae and Freddie Mac, the two giants backing much of the US mortgage market, are taken over by the federal government. The 15th of September 2008, Lehman Brothers, 158 years old, files for the largest bankruptcy in American history. The 16th of September 2008, AIG, the insurance giant, that had sold enormous volumes of those credit default swaps needs an $85 billion emergency rescue to avoid collapse the very next day. Within weeks, credit markets worldwide seize up, banks stop lending to each other because nobody knows anymore who's holding the bad debt. October 2008, the US government pushes through a $700 billion emergency bailout package for the financial system. Stock markets from Tokyo to London to New York post some of their worst single day losses in history. By early 2009, the crisis has stopped being a Wall Street story and become everyone's story. Unemployment lines, foreclosure notices taped to front doors, retirement accounts cut in half. The strawberry picker signature, 4 years earlier, is now four continents and a global recession away from where it started. The bank in Dusseldorf, the one that needed a rescue because of a loan to a strawberry picker in Bakersfield, was just one of dozens of institutions across the world, from Iceland to the UK to Ireland, that discovered they were holding pieces of the same collapsing bat. Here's the number that should make you angry. The same year, the system they built nearly collapsed the global economy. Very few senior US banking executives faced prison for conduct directly tied to the crisis. Trillions in damage. One person. Meanwhile, the government's rescue programs kept many of the largest banks alive and, within a few years, more profitable than before the crisis. The people who lost homes rarely got a second chance at a mortgage that fast. The institutions that built the machine mostly got a second chance immediately, backed by taxpayer money. So, did we fix it? Partly yes. Regulators forced banks to hold significantly more capital as a cushion. The Dodd-Frank Act created new oversight rules and a consumer protection agency. Banks now undergo regular stress tests simulating economic collapse. Some of the riskiest mortgage practices were banned outright. These are real reforms, not theater. But notice what the fix actually targeted. It targeted the costume, the specific mechanism of 2008 subprime mortgages, specifically bank capital ratios, specifically it made banks harder to blow up in exactly that way. Again, what it did not do is remove the underlying pattern, risk getting separated from the person who created it, repackaged until nobody can trace where it actually sits, and rated as safer than it is by whoever's being paid to grade it. That pattern didn't disappear, it moved. Private credit operates under a different and, in some areas, less intensive regulatory framework than traditional banks. Much of it is opaque, much of it is leveraged. Nobody outside the industry has a clear, complete picture of exactly how interconnected it's become. Alan Greenspan, the man who ran the Federal Reserve for nearly 2 decades, told Congress in 2008 that he had found a flaw in the model he'd relied on his entire career, the assumption that banks, acting in their own self interest, would naturally protect their shareholders and, by extension, the system. That flaw wasn't patched, it was relocated. Think about what private credit actually is structurally: loans made outside the banking system to companies instead of homeowners, this time held by funds instead of banks, marketed to pension funds and insurance companies as steady, reliable, low volatility returns. The people managing the risk aren't always the people who'll answer for it if it goes wrong. The people rating how safe it is are sometimes paid, directly or indirectly, by the people asking for the rating. None of that makes it 2008, but all of it should sound familiar. Nobody had to be able to build the machine that almost broke the world in 2008. They just had to be reasonable, one meeting at a time, inside a system that rewarded exactly that kind of reasonableness. So here's the question worth sitting with. Not will there be another crisis? There will be. Eventually, there always is. The real question is this: what does everyone in finance currently agree is obviously boringly safe? Because that's exactly where it always is.